India's premier private bank CEO under criminal investigation. On May 30, 2025, a Mumbai magistrate ordered Bandra police to file an FIR naming Sashidhar Jagdishan, CEO of HDFC Bank, over an alleged 2.05 crore payment filed by the respected Lilavati Mehta Medical Trust. It's a legal clash between two powerful institutions. Over the next 20 minutes, we'll unpack who the trust is, delve into Jagdishan's background, explore the FIR claims, trace a 30-year loan saga, examine legal responses, assess how market and media have reacted, and reveal what's next in this high-stakes drama. Welcome to Unfiltered Workspace. The Lilavati Mehta Medical Trust. Have you ever heard of it? You probably have, especially if you have ever driven past Mumbai's Bandra reclamation. Founded in 1978 by Kirtilal Manilal Mehta, a legendary diamond trader and philanthropist. The trust was created in memory of his wife Lilavati Mehta. Today it operates the iconic Lilavati Hospital and Research Center, one of the India's most prominent private medical institutes. It's not just a hospital, it's a landmark, known for its cutting-edge treatments, high-profile patient list, and deep philanthropic legacy. Lilavati Hospital blends celebrity healthcare with public service. Over the decades, the hospital has treated everyone, from film stars and industrialists to underprivileged patients through its charitable wing. The trust is run by members of the Mehta family, including trustees like Prashant Mehta, Charu Kishore Mehta, and others, who have been central to this hospital expansion and management decisions. However, behind the prestige and philanthropy lies a long simmering internal conflict. The family-run trust has faced multiple legal disputes over governance, board decisions, and allegations of internal power struggles. These tensions, mostly kept behind the closed doors, have now spilled out into the public eye with explosive claims. In a surprising move, the trust filed a criminal complaint against Sashidhar Jagdishan, the CEO of HDFC Bank, one of the India's most respected banking figures. This shifts the trust from healthcare headlines to the center of serious financial scandal. Let's shift focus to the man at the center of the storm, Mr. Sashidhar Jagdishan, the CEO of HDFC Bank. Jagdishan isn't just any bank executive, he is one of the most influential figures in Indian finance today, steering the country's largest private sector lender with over 25 lakh crore in assets under management. His journey began in Mumbai, where he earned a BSc in physics from Mumbai University, followed by a master's in economics from University of Sheffield in the UK. He also qualified as a chartered accountant, giving him a rare mix of analytical, economic, and regulatory understanding. He started his professional career at Deutsche Bank, but it was 1996 that he joined HDFC Bank, then a fast-growing private lender with a reputation for clean governance. When Mr. Puri stepped down in 2020 after a 26-year run, Jagdishan took over as CEO on October 27, 2020, marking a generational transition. Many viewed the appointment as a sign of internal stability and continuity. His tenure hasn't been quiet. Jagdishan has overseen the complex merger of HDFC Limited and HDFC's Bank, one of the largest finance mergers in Indian history. Under his leadership, the bank has doubled down digital transformation, lending tech, and regulatory compliance. In 2023, the RBI extended his term until October 26, 2026, underscoring international trust in his stewardship. He is also known to maintain a relatively low public profile despite being one of the India's most powerful bankers. All of this makes the current allegations even more shocking. This isn't a new executive or a fringe player. This is a seasoned CEO with decades of experience, institutional trust, and a reputation of a clean banking. Which begs the question, how credible are these allegations? Or could they be a legal strategy meant to pressure the bank? Now let's get into the heart of the controversy, the FIR itself. On May 30, 2025, a Mumbai magistrate in Bandra directed the police to register an FIR naming Sashidhar Jagdishan and seven others. The complaint was filed by the Lilavati Mehta Medical Trust, and the court found enough prima facie substance to order formal investigation. At the core of the complaint is a handwritten cash debt allegedly discovered during internal disputes among the trust members. According to the trust, the diary documents illegally payouts totaling 14.42 crore between 2017 and 2022. One specific entry allegedly shows a 2.05 crore payment to Mr. Sashidhar Jagdishan in 2022. The diary, they claim, wasn't a vague note. It contained specific names, dates, and initials indicating bribes or coercive payments made by bankers, law enforcement officials, and individuals linked to the debt recovery dispute with HDFC. In Jagdishan's case, the trust alleges that this 2.05 crore was used to coerce or manipulate the father of a sitting trustee, influencing key decisions related to the hospital's governance and the family's legal strategy. The FIR was filed under serious sections of the Indian Penal Code, including Section 409, Criminal Breach of Trust by a Public Servant or Banker, Section 120B, Criminal Conspiracy, Section 201, which is Destruction of Evidence, and the other provisions related to the cheating and forgery. What makes this unusual is that the magistrate didn't simply forward the complaint to police, but he directed Bandra police to file an FIR immediately, indicating judicial concern this was not a routine filing. According to court documents cited in news reports, the magistrate noted that the evidence was sufficiently specific to warrant a full criminal inquiry, and that the trust has submitted digital scans of the diary, bank transaction records, and call logs to support its claims. There was no longer just a family allegations, but they are now subject to an official criminal investigations involving one of the country's most powerful bankers. Now let's talk about the decades-old loan battle that ties the entire FIR case together. Because the allegations of bribery don't exist in a vacuum, but they are deeply linked to an unresolved financial conflict between the Mehta family's company and HDFC Bank. The story starts back in 1995 when a Mehta-controlled company named Spender James Limited took out a consortium loan led by the HDFC Bank. At the time, the loan was considered standard working capital, and Spender James was a thriving part of the family's diamond business. But by 2001, the company defaulted on payments. The loan was declared an NPA, non-performing asset, which triggered legal action. In 2004, the Debt Recovery Tribunal (DRT) issued a formal recovery certificate, allowing HDFC Bank to begin legal enforcement on dues. Over the year, however, the exact amount owed has been subject of major dispute. While the Mehta claimed the original loan was just 4.8 crore, HDFC Bank says that with accumulated interest, penalties, and compounded dues, the outstanding amount as of May 31, 2025 stands at 65.22 crore. Even more confusing, the trust alleges that HDFC had once claimed 450 crore, that lowered it to 65 crore without ever submitting the clear loan agreements, ledgers, or account statements in the court. They have accused the bank of manipulating figures to inflate the liability. The trust's lawyer have argued in multiple filings that no legally enforceable loan agreement has been produced since 2004. Despite repeated court directives, they claim that HDFC is relying on recovery certificates without supporting transactional evidence. The HDFC Bank, on the other hand, says the FIR was filed only to delay the repayment and stall asset recovery. In June's 8 statements, the bank alleged that the FIR is strategic counter blow, a way to pressure the bank into dropping into a legal pursuit of the dues. In essence, we are looking at two high-powered entities using legal systems as leverage. The trust is alleging corruption and coercion. The bank is alleging obstruction and financial evasion. And in between, a 30-year-old loan that's become a legal minefield. HDFC Bank was quick to push back, strongly and publicly. On June 8, 2025, the bank released an official statement calling the FIR malicious, baseless, and a gross misuse of a legal process. Their language was sharp and calculated, clearly designed to signal both confidence and legal readiness. Then on June 11, they doubled down. In a second press release, HDFC Bank called the timing of the FIR devious, alleging that it was deliberately filed to derail lawful recovery proceedings tied to a 65.22 crore loan. They accused the Mehta of weaponizing the criminal justice system to shield themselves from financial accountability. Here's take a look on June 11 statement said. The bank was reaffirmed its position that 65.22 crore remains outstanding and is supported by a valid debt recovery tribunal certificate. According to HDFC, the trust's accusations are merely a distraction from a legal debt. But the bank isn't stopping at the public denials. Sources close to HDFC say that they are preparing to file a civil defamation suits against the trust and possibly its individual trustees. They are also reportedly drafting petitions to regulatory bodies like Reserve Bank of India and the SEBI, asking them to take a notice of what is the bank sees as corporate level defamation. Financial insiders say that this kind of strong reaction is rare, but understandable. This isn't just a PR issue for HDFC, because it could influence their stock valuation, public trust, and even the stability of their executive leadership. In short, HDFC Bank is going all in to shut down, legally, reputationally, and financially. Just one day after HDFC's aggressive June 8 response, the Lilavati Mehta Medical Trust hit back with equality serious claims. In a press briefing and a court filing dated June 9, the trust said HDFC Bank's narrative is fundamentally flawed and designed to manipulate public perception. The key allegation that no original loan agreement or audited ledger has ever been produced by HDFC in a court, even after nearly 2 decades of litigation. According to the trust, HDFC was revised the owed loan amount multiple times without an explanation. First it was 4.8 crore back in 2001, then came a dramatic leap to 450 crore, which the trust says was never formally documented. And now, in 2025, it's 65.22 crore, a figure that the trust argues is still unsupported by underlying agreements. The trust accused the bank of using confusing numbers, opaque feelings, and procedural gaps to keep the recovery process going without ever proving the debt. But the most serious part of their rebuttal is not financial, it's personal. The FIR alleges that HDFC Bank's executive diverted 1.5 crore in CSR funds, money meant for charitable use, into unrelated transactions designed to influence or pressure trust members. In fact, the complaint claims that these coercive tactics created prolonged mental harassment, which allegedly contributed to the death of the founding trustee in 2024. While the FIR does not accuse anyone of direct causation, it links to stress and intimidation allegedly applied by the bank officials to the trustees' deteriorating health. In their formal demands, the trust is not holding back. Let's see what they have asked for. First, the immediate suspension of CEO Sashidhar Jagdishan, pending investigation. Second, the independent audit of 1.5 crore CSR funds. Third, criminal prosecution of all 8 accused under IPC sections including criminal breach of trust and conspiracy. Fourth, and perhaps most significantly, regulatory action by the RBI and SEBI, given to the public impact and severity of the accusations. The trust argues that this is not the case of one loan gone wrong, but of a bank using its institutional power to bully a charitable institutions like financial submission. As of now, both sides are accusing the other of abuse of law, power, and trust. And now India's financial regulators are watching closely. Despite the seriousness of these allegations, the stock market hasn't even blinked. On June 12, 2025, HDFC Bank shares hovered around 1946 rupees to 1949 rupees, virtually unchanged and just shy of its 52-week high of rupees 1968. That suggests investors are either confident in HDFC legal standing or waiting for more concrete developments before reacting. Market analysts say that this reflects strong institutional backing, especially from mutual funds or FIIs, who are heavily invested in HDFC as a bellwether stock. Until there is regulatory action or proof of a financial manipulation, HDFC is still seen as too big to fail. But the media narrative isn't as forgiving. The Economic Times framed the case as a clash of titans, emphasizing the rare spectacle of a powerful private bank locked in a legal war with a respected medical trust. The Cane, a subscription-based financial newsletter, raised a question over HDFC's shifting loan figures, especially the alleged jump from 4.8 crore to 450 crore to 65.22 crore. They also pointed the potential documentation black holes in the bank's recovery process. The Financial Express highlighted the mental anguish angle, questioning whether the CSR funds are misused not only financially but emotionally, especially in relation to the 2024 death of a founding trustee. And the New Indian Express took a broader view, warning of reputational risks to India's banking sector if this case triggers regulatory interventions or executive level resignations. On social media, sentiment is sharply divided. Some users accuse HDFC of high-handedness and opaque dealings, while others see the FIR as a delaying tactic by the defaulters, trying to stall payment on a decade-old loan. Either way, this isn't just a legal drama. It's public credibility test. And so far, the stock may be stable, but the narrative isn't anything but. Behind the courtroom drama and shifting headlines, this case could reshape regulatory and corporate accountability standards in India, especially in the financial sector. Legal analysts say that the next few months will follow a five-front escalation. Number one, police investigation. Bandra police are now bound by the court's order to register and investigate the FIR. That means summoning all eight named individuals, including the CEO Sashidhar Jagdishan, for questioning, conducting forensic examination of all handwritten diary mentioned in the FIR, tracing fund flows, potential shell companies, and links to any CSR misappropriations. If the diary is validated and money trails confirmed, this could escalate the changes under sections like 420, 467, 468, and 409 of the IPC. HDFC Bank is expected to challenge the FIR's validity in a session court or possibly approach the Bombay High Court under Section 482 CRPC. The court will likely assess whether the diary evidence holds prima facie weight, whether the FIR is being used as a retaliatory weapon to detail legitimate loan recovery. The outcome here will set a legal precedent for how private disputes with financial institutions can or cannot be criminalized. Third, regulatory oversight by RBI and SEBI. If evidence emerges suggesting governance failure, the RBI may initiate a fit and proper test for Jagdishan per the 2016 RBI guidelines for the bank's CEO. CBI meanwhile could look into this, whether shareholders were adequately informed about the risks, if there was selective disclosure that violates listing norms. Any red flags here could result in penalties, board scrutiny, or compliance orders. Fourth, civil suits and defamation war. HDFC has already signaled defamation action. Insider sources report possible civil suits upwards of 1,000 crore, covering reputational loss, emotional distress, and legal expenses. The trust too may counter with contempt petitions if it finds evidence of document suppression or witness intimidation. Fifth, boardroom turbulence. Even if court and regulators delay inaction, pressure on HDFC's board may build internally. If the FIR gains traction or reputational damage grows, independent directors could push for Jagdishan's temporary leave, appointment of a compliance oversight committee, or even the voluntary RBI audit to restore the trust. Bottom line, this is no longer about 2.5 crore. It's about how India's top financial institutes defend themselves, police their CEOs, and respond to the criminal allegations. This case will not only test one bank but the strength of our corporate governance and regulatory guardrails. To understand the deeper implications of the Lilavati and HDFC dispute, we need to step back and look at past governance breakdowns in India's financial sector. In 2018, Yes Bank became cautionary tale of how unchecked executive power, opaque lending, and board complicancy can unravel a top-tier bank, and founder CEO Mr. Rana Kapoor faced charges of money laundering, fraud, and favoritism, ultimately leading to RBI intervention and the forced restructuring. A year earlier, in 2017 to 18, the Infrastructure Leasing and Financial Services Limited collapse revealed how financial juggernauts could hide systematic weaknesses behind the complex ownership waves. The fallout wiped out public wealth and shook investor confidence across the NBFCs. So, what was the common thread in this case? Broad silence in the face of red flags, lack of independent oversight, and failure to protect stakeholder interests from retail investors to employees. Experts now say that the Jagdishan FIR may represent a new governance flashpoint, but with a twist. It's not just about corporate accountability, it's about how charitable institutes and corporate giants collide. As one governance consultant wrote on LinkedIn last week, this isn't just about the HDFC or Lilavati. This is about the ethical firewall between the CSR check and the bribe allegation. This case also raises a critical question. Should CXOs involved in the public-facing institutions, like banks or charitable hospitals, be held in even higher fiduciary standards than regular corporate boards? With more corporate money flowing into the charity sector via CSR mandates, this case might trigger calls for independent audits of CSR disbursement, clear separation of operational and philanthropic boards, and stronger whistleblower protections for the trustees and internal dissenters. If this crisis forces the introspection, it could set a much needed benchmark for India incorporation to finally address governance beyond the balance sheets. So, what's really going on here? Was 2.05 crore a bribe? Or is this FI just a way to avoid paying back 65 crore? We have got a handwritten cash diary, changing loan figures, CSR misuse claims, and even a trustee's debt tied to a mental distress. This isn't just a financial fight, it's a serious legal and ethical mess. Will investigators find real evidence, or is this just a high stakes blame game? Drop a comment. Who do you believe? If this video helped you make sense of the story, like, subscribe, and hit the bell so you don't miss any other update. You're watching Unfiltered Workspace, where we explain what others complicate. I'm Abhay. See you in the next one.